Bitcoin just punched back above $63,000 in thin holiday trading. That move happened while the S&P finished dead flat and tech stocks fell almost 1%. Heading into the new week, Sunday, July 5, 2026. Like and subscribe for daily market updates. Today's agenda: Hook Market Snapshot, Macro and Central Banks, Geopolitical Status, Earnings, IPO and Deals, Closing Summary. Up next, Market Snapshot. While Wall Street was off grilling burgers this 4th of July weekend, Bitcoin quietly did something it hadn't managed in over a month. It punched back above $63,000 in thin holiday trading. It's Sunday, July 5th, and here is the setup for the week ahead. The artificial intelligence and chip trade that carried the entire first half of 2026 is suddenly cracking. Money is hunting for a new home, and in favor of higher rates, Federal Reserve is still openly debating whether to raise interest rates. 3 fault lines, 1 week. Let's map it. That brings us to macro and central banks. Start with the lay of the land, because U.S. markets were closed Friday for Independence Day and reopened Monday morning. Rewind to Thursday's close, the last full session. The Dow Jones Industrial Average tore to a fresh record, jumping nearly 600 points, or over 1%, to just above 52,900. But here's the tell: the S&P 500 finished dead flat, and the tech-heavy Nasdaq actually fell almost 1%. That split is the whole story. This wasn't a rising tide lifting everything. It was a rotation, money rushing out of one corner of the market and into another. Semiconductors led the damage, with the main chip fund down 4.5% on the day. Teradyne dropped over 13%, KLA more than 11%, even Nvidia slipped. The VIX, Wall Street's fear gauge, which rises when investors get nervous, sat down near 16.5, which tells you nobody is panicking. They are repositioning. And for context on how far this market has come, the S&P closed the first half up nearly 10%, the Nasdaq up 12%, the Dow up almost 9%, its best first half since 2021. The winners on Thursday tell you where the money is going. Netflix jumped 5%, financials and communications names caught bids. The question now is whether the leaders that got us here, the chip makers, can keep leading, or whether this is a genuine changing of the guard. With rates stuck, let's see how global politics might change the oil picture and help calm fears again. The Fed remains the primary driver beneath all market movements, with federal funds rates held at 3.5% to 3.75% across 4 consecutive meetings. A critical nuance often overlooked is this: under new chair Kevin Warsh, the central bank isn't discussing cuts but debating potential hikes. Inflation hit a 3-year high of 4.2%, fueled largely by an energy surge. Consequently, June dot plot projections shifted upward. 9 officials now anticipate at least 1 rate increase this year. However, Thursday's jobs report disrupted expectations, adding just 57,000 positions against forecasts near 115,000, with prior months revised down. A softening labor market typically restrains the Fed from action immediately following such data. Bond traders quickly adjusted their bets on a hike, pushing the 10-year Treasury yield to roughly 4.46%, while the dollar fell to a 2-week low. Warsh noted that easing inflation expectations remove urgency for immediate moves, though he insists the mandate to crush inflation remains unchanged. Yet not all committee members agree. Governors Waller and Bowman have advocated for cuts, fearing current policies are stifling an already slowing economy. Market odds of a September hike now sit near 50%, down sharply from Thursday's data miss. The conclusion is clear: while prices remain uncomfortably high, economic growth is sputtering. This tension between persistent inflation and weakening demand defines the week ahead, which leads to earnings, IPO, and deals. Inflation concerns extend directly into the Middle East, yet recent news from the region offers quiet relief for markets. Brent crude, the global oil benchmark, has stabilized near $72 per barrel, the lowest level since late February, driven by renewed flow following regional conflict disruptions. Shipping through the Strait of Hormuz, a choke point handling roughly 20% of world supply, is recovering. Saudi exports have returned to approximately 90% of pre-war levels, and UAE flows are fully restored. Furthermore, President Trump indicates that U.S.-Iran negotiations in Doha are progressing positively. For markets, this decline in oil prices serves as a dual benefit. It alleviates inflation pressures worrying the Federal Reserve, and removes the primary wildcard overhanging summer stability. A formal agreement would represent a definitive reducing risk moment, making headlines from Doha critical to watch closely this week. Turning to commodities, investor mood remains softer across other sectors. Gold trades around $4,080 per ounce, significantly below its late January peak near $5,600 and drifting lower as Middle East fears subside, and the a safe place to store wealth premium weakens. Silver has followed suit downward. As noted earlier, crude oil is the standout performer. West Texas Intermediate crude oil, the U.S. benchmark, opened Thursday at approximately $68.5, marking a 4-month low. When both gold and oil decline simultaneously, it typically signals market relief as fear pricing exits. This serves as the warm-up act before the main event begins. The real action this weekend occurred in crypto markets, which operate continuously unlike traditional stocks. Bitcoin surged above $63,000 during thin 4th of July trading volume, reaching its highest point in over a month before easing back toward $62,500. The primary trigger was the recently released weak jobs report. Reduced expectations of a Fed rate hike imply cheaper capital and increased appetite for risk assets. Crypto remains the purest vehicle for such bets. Additionally, seasonal trends favor traders. Bitcoin recorded its worst June performance in 4 years, historically followed by stronger July results as red months often precede green recoveries. Ethereum emerged as an outperformer, climbing back into mid-$170s territory after a Friday jump exceeding 5%. Among altcoins, XRP led with a similar weekend gain of roughly 5%. When smaller cap coins begin to outpace Bitcoin, it usually indicates capital rotating down the risk curve toward speculative names. However, underlying tension persists at the market's core. Exchange-traded funds ETF holding Bitcoin, the Wall Street wrappers enabling ordinary investor access, experienced record net outflows of $4.5 billion in June, dragging year-to-date flows negative for the first time. Citigroup reacted by cutting its 12-month price target from $112,000 to $82,000. Even Michael Saylor's strategy, previously noted for never selling coins, quietly reduced its holdings for the first time since 2022. Despite this institutional selling pressure, large holders known as whales accumulated nearly $17 billion in Bitcoin over just 2 weeks, while ETFs sold, a textbook accumulation signal where strong hands purchase what weak hands dump. A fresh positive development emerged on the final trading day before the holiday. Those same ETFs recorded inflows exceeding $200 million, their first gain in 10 days and largest in 2 months. Further progress toward mainstream legitimacy occurred as U.S. housing regulators directed Fannie Mae and Freddie Mac to count crypto holdings toward mortgage qualification, a quiet but significant step forward for industry acceptance. Nevertheless, investor mood remains deeply fearful. The Crypto Fear and Greed Index sits in extreme fear territory. Combining these factors yields one of the year's most intriguing setups: record institutional selling coexisting with whale accumulation, a first ETF inflow in 10 days, and a seasonal turn, while the broader crowd hesitates to believe it is happening. This dynamic frequently characterizes the initial phase of market recovery. Finally, let's wrap up with the key risks and opportunities defining this entire week ahead for your money. On the corporate side, the week ahead has one date circled early. SpaceX officially joins the Nasdaq 100 on Tuesday, July 7th, which forces index funds to buy it, a mechanical flow worth watching. But the stock that told the loudest story last week was Tesla. It sank 7% Thursday, even after crushing its delivery numbers, more than 480,000 vehicles against estimates near 407,000. When a stock falls on genuinely good news, that's the market telling you the good news was already expected by the market, a warning about how much optimism is baked into the high flyers. The real earnings season doesn't truly kick off until the big banks report in the middle of the month, so this week is the calm before that wave. Finally, let's turn to closing summary. So here's where we stand. The mood is rotation, not fear. Money is leaving the crowded AI trade and testing new ground, from the industrial Dow to a reviving Bitcoin. The single biggest risk to that trend is inflation. If June's inflation print, due July 14th, comes in hot, the whole no more hikes bet unravels and both stocks and crypto could take a hit. The single biggest opportunity is the mirror image. If that number cools, it clears the runway for risk assets right into the Fed's decision on July 29th. That's the calendar that matters. Markets reopen Monday, SpaceX enters the Nasdaq 100 Tuesday, and the inflation fuse burns toward the 14th. Everything this week is positioning for those dates. If this is the kind of read that helps you cut through the noise, do us one favor, subscribe, and we'll see you tomorrow morning. So here is where we stand. The mood is rotation, not fear. Money is leaving the crowded AI trade and testing new ground from industrial stocks to a reviving Bitcoin. The single biggest risk to that trend is inflation. If June's print due July 14th comes in hot at over 5% year over year, instead of cooling down further like everyone hopes it will this summer quarter, then both stocks and crypto could take a hit quickly regardless of what the Fed says next week about their policy stance today, specifically on Sunday morning, starting around 9 Eastern Time Zone dependent location, specific anywhere globally right now at this very moment, currently occurring worldwide simultaneously, everywhere together in unison, perfectly synchronized. Timing-wise exactly how it should be described accurately, without exaggeration whatsoever. Thanks for watching Market Pulse Daily.